Hi everybody, this is Robert Palmer, Director of Financial Planning here at Avidian Wealth Solutions. Joining me today is Jake Borbidge, our Chief Investment Officer. And Jake, I'm going to throw you a question right off the bat. Why should long-term investors not be looking at the market?
Robert, that's a great question. Happy to be here with you again today. The first reason I would say is just because everybody has 24 hours in their day. And you want to make sure you're using your time wisely. And, watching the market for most people is an extremely stress-inducing exercise. And it's just generally not a good use of your time. Happy to get into why it's not a good use of your time. But generally speaking, it's just not going to be a productive exercise and a productive use of your time.
But Jake, when I turn on the TV and all these people are talking, there seems to be opportunities every day. And I don't want to miss any of them. What do you say to people that take that perspective?
Well, I would have stopped you at TV. And I think, the first thing you want to know about watching and consuming market information through the television is an entertainment device. And the individuals on there, they may be really smart. They may sound like they have a lot of great ideas. But at the end of the day, their job is to entertain you first, sell advertisements first, and then maybe provide some interesting information. But the primary objective is entertainment.
Okay, so all the figureheads out there I should be looking at as entertainment, but what if I want good information? I actually want to identify an opportunity. Where do I go? Who do I trust?
You can absolutely trust avidianwealth.com, where we are chock full of resources that you can find answers to many of your financial questions. Aside from that shameless plug for our services, I think the most important thing is that when we look at the markets, what we try to do first is we try to tune out the noise. And I would define noise as anything that's going to come up today and has a high probability of changing tomorrow or within the next couple of weeks. Those data points, they may be interesting to watch. They may catch a lot of headlines. CPI is a good example, right? It catches a lot of headlines, ultimately doesn't really drive the markets, especially not over the long term. So I think the first thing that you need to do is make sure that you're able to tune out the noise, focus in on things that actually matter, that actually drive markets going forward, but also talk to a trusted financial professional, somebody that does this for a living and does it all day long, every day.
Well, you are a trusted financial professional as CIO.
Thank you for the trust.
Another shameless plug. Just curious, where do you get your information from when you want to do some due diligence on the markets?
So I'll start by saying I'm in the same boat as most of y'all listening to this thing. I am inundated with information, facts, opinions every single day through my email inbox, through the news, through various different information sources. And so I'm constantly trying to tune out the noise and focus in on the drivers. Thankfully, I've been doing this for about 20 years now, and so I've gotten really good at tuning out noise and getting focused. So the things, first off, where do I get the information from? Whether you get the information from a data provider like we subscribe to, we have a number of software options at Avidian. One of them is Bloomberg, which is a nice option to have. One of them is FactSet. There's a lot of brands out there that you can buy data from, but it's not necessarily where you get your data. It's which data points do you pay attention to. And I would say things like yesterday's change in price, those are not data points that I pay attention to. A lot of macroeconomic data that comes out that's really interesting, election probabilities, polling results, CPI numbers, those things, interesting data points, don't have a lot of impact on what drives the market. What I think drives the market over the long term, valuations matter. Valuations matter, though, over a 3-year period. Valuations don't matter tomorrow. So if something's expensive today, doesn't mean it's going to change and become cheap tomorrow or become fairly priced tomorrow. Growth is another thing that matters. If you look out over a 10-year horizon, the opportunity or if you look at what drives returns, especially in the stock market, valuations can drive a small component, but over the last 20, 30, or 50 years, the real swing factor has been growth and really earnings growth in corporations. So if you start focusing in on corporations' ability to drive earnings, to drive revenue, increase margins over time, that's really where the good information is.
Well, here's an example of a news headline that I know a lot of people were paying attention to in the market. Jerome Powell came out yesterday, again, as he does every month, and he's talking about interest rates, and everyone is watching interest rates. Now, that might be because a lot of people are in growth, and they want to make sure that growth is going to continue, and lower interest rates feed into that, or maybe people are looking to refinance. But should I be paying attention to that at least?
So I think the overall macroeconomic backdrop, it does matter for growth. However, the timing of the first 25 or 50 basis point rate cut, that doesn't have a huge impact on earnings, especially when the next couple quarters, materialize. We all know that Fed action takes a long time to play out. We're seeing the results today of Fed action that was implemented, a number of quarters ago.
It's a great point.
So as we approach these meetings and the market starts to speculate, are we going to get a cut? Are we not going to get a cut? What that does is it affects the risk appetite of the market. So risk appetites will affect market prices in the short term, call it a couple days, call it a couple weeks, but not over the next 10 years. The overall macroeconomic environment, are we in a macroeconomic environment, or do we have Fed policy in place that is designed to halt or reduce earnings, right? Provide some brakes on the system, or are we in an environment that's stepping on the gas? That can have an impact on growth over time, but whether we go from 5% to 5.25% or 4.75%, we're still in the same overall economic environment. That's not going to have a huge impact in whether companies are able to generate earnings over the next several quarters or the next several years.
And this kind of circles back to your previous point where it's really about the numbers painting an accurate picture, not the passionate investors that are coming in and out every day.
That's correct. So as we look out, again, we try to take a long-term approach. We are thinking in terms of 5 years, 10 years, in some cases 20 years when we put together our financial plans. The risk appetite of markets, that may create some attractive entry points, but in a 10-year horizon, even if you enter the market, call it 10% off, that only affects your return 1% a year when you string that out over 10 years. And in some cases, it's a lot less than that. So even if you buy on a market dip, that doesn't have a huge impact on your overall performance as it relates to your long-term financial plans. What matters more is whether you're invested in things that are going to be able to grow and hopefully outgrow the rate of inflation and create real returns so that you increase your ability to purchase things when you ultimately need those funds.
So if I'm a long-term investor and I don't want to be worrying about the market every single day, what are some steps that I can do to kind of get myself into an investment strategy that's going to make me feel that way?
So I think the first step is to have a financial plan in place, right? So one of the things that we like to educate our investors or our clients on is to shift away from thinking about themselves as just investors as their function and think about more of a financial planning exercise, right? That'll help to align your viewpoint with a long-term focus. It'll create goals that are achievable. A goal of an investor or somebody that is trying to fashion themselves as an investor is to win every day. That's not really an achievable goal. Markets are going to go up, markets are going to go down. Markets going down shouldn't create stress because that's a buying opportunity a lot of the times. Markets going up isn't necessarily a great result either. It just might mean that you're paying a little bit more than you were the day before for investments that you're not going to liquidate for 10 or 20 years. And so I think step one is converting your thought process from having to win every day or having to see your portfolio go up and down every day to taking that long-term goals-based approach, which you can get through financial planning.
Yeah, I think strategically, and I'm going to circle back to financial planning just because that's what I do every day. But I usually find that if you start before diving into the markets and everything, you identify your cash flow situation, what your expenses are, what your income is, and you forecast it out and you establish an emergency fund. It sounds like a very basic step, but if you have those components, you don't have to worry about the day-to-day. You don't have to worry about what you have to sell in order to pay something off because you've already accounted for that in the future. And so that proactive planning kind of gets you to that financial stability where the day-to-day doesn't impact you as much. Now, if you want to go a little bit deeper into more advanced strategies, what you're really looking to do is tax optimization from a financial planning standpoint, because that puts more money in your pocket today, making it easier for those long-term investments to sit and ride. And the way that you typically do that is, first thing is you look at the businesses that you have access to, right? Either you're running a business, maybe you're partnered in a business. Businesses serve as great vehicles for tax write-offs, right? There's going to be certain expenses you can write off through the business, certain assets you can acquire and then depreciate quickly through the business, all of which is going to create a tax arbitrage where you're putting more money and more assets into your pocket today, and it's feeding into that long-term financial plan. And I think this is how institutions also think in terms of what they're able to do in the long term and how they're able to capitalize in the short term to get there. So Jake, why don't you talk a little bit about how institutions invest?
That's a great parallel, Robert. And one of the things that we try to do here at Avidian is we want to make sure that every one of our families is able to invest like a large institution.
Absolutely.
That's basically our mission statement. And the way that an institution would look at the problem is they would say, okay, I have cash flow needs. There's some short-term cash flow needs. There's longer-term cash flow needs. They would develop a policy around what cash flow needs they want to have fully determined by no risk or very low risk assets. And what that does is that frees up capital to take risk. And so when you know that you have your cash flow needs met over some period of time that you're very comfortable with, that risk capital automatically becomes a long-term investment, and that frees up your ability to take risk, but also do so in a very pragmatic and thoughtful way where you are not putting capital at risk that you may need in the next couple months or couple years.
Now, I want to circle back again and go into investment management.
Getting dizzy here, Robert.
I know, we're going in circles. But if we're looking at investments now, let's say my cash flow is stable, I forecasted out my expenses, I have goals, but now I need investments to reach those wealth goals. What kind of investments should I be looking for? Should they be predominantly the things I see on TV all the time, the public markets, or are there alternatives?
So I think it's a little bit of both. There's an overused word, but we believe very strongly in diversification. And so we think about diversification from a number of different angles. Asset class diversification we think makes sense. That's, do I have equities? Do I have bonds? Do I have investments in the U.S. or outside the U.S.? Do I invest in small companies or large companies? Those are all diversification questions to us. But we also think about diversification in terms of, do I put all of my money in liquid vehicles, or can I save some of my money and put it in alternatives or private markets? And especially since we're talking about, do I watch the markets? Do I pay attention to the day-to-day? Do I watch the news feed? Or do I have a little bit more peace of mind? One of the benefits to private markets is just that they don't price on a daily tick-by-tick basis like your public market investments will price. So there's a little bit of a trust transfer. You have to be able to trust that your private markets are working for you, because you don't get that minute-by-minute, tick-by-tick feedback. But you also don't see the value of your portfolio fluctuate substantially at the whims of the market, right? If the market is in a more risk-seeking behavior, which can happen over time, you can see those assets increase in price. But the same is true of the opposite is true if the market is in a more risk-averse behavior. And that can be just determined to things that don't have a whole lot of impact over the market or over a company's ability to produce earnings, but they can have an impact on the risk appetite. So public markets, you're going to see more fluctuations. Private markets, you might be a little bit more insulated from that. So not only does it offer some diversification opportunities to open up asset classes you can't otherwise access, but it gives you a little bit more of a muted portfolio experience because you're not seeing those day-to-day price fluctuations.
Well, help me out definitionally here, because I hear people throwing around the term alternatives and private markets all the time. What exactly is meant by a private investment or a private market?
So that's a good delineation. So a lot of times you see those terms used interchangeably, and there are a lot of cases where that is a reasonable usage of the term. But I'll start with alternatives. So to me, and everybody has a little bit of a different definition for alternatives. My definition for alternatives are anything that is not public equities or publicly traded bonds. So things like commodities, which are still publicly traded, could be considered alternatives, and I would consider those alternatives. Likewise, real estate infrastructure, things that could be publicly traded, sometimes are not. I still think of those as alternatives. Public versus private is a little bit of a different differentiation. So anything public to me is anything that you can buy or sell on a stock exchange. Those would be ETFs, those would be mutual funds, those would be individual stocks or publicly traded bonds, or even futures, right? If you're looking at commodities and some of those alternatives. Options, another thing that is publicly traded, right? Private would be something that you cannot trade on an exchange, you cannot get daily liquidity on. So things like, if you invest in real estate, but you invest in a fund that invests in individual buildings that cannot be publicly traded, cannot be sold, on a moment's notice. I consider that to be private investments where private equity, where you're investing directly into companies or into portfolios of companies. Those companies that are not listed on a stock exchange, that would be a private investment.
So it sounds like private investments, illiquidity sometimes is seen as a bad thing, but in a way it kind of forces you to get that long-term perspective that we were talking about earlier, because you have to kind of wait it out and see how it goes, right?
Yes, it definitely forces you to be a long-term minded investor, especially when you go into private markets, because you know that your money is going to be put to work for you for an extended period of time, and you're not going to be able to access it. But one of the benefits there is that you're providing capital into an area where capital tends to be more scarce. And so there is a benefit that we expect to receive by providing capital into that, that scarce place, right? It's almost like you're bringing water into the desert. Water in the desert's worth more than water next to a lake.
Well, Jake, as always, great insights. Thank you so much for the time today. I really enjoyed our conversation.
Robert, as did I. Hopefully we're able to bring our clients some level of financial peace they didn't have before listening to this. And another plug, if you have more questions, go to avidianwealth.com and look us up.